term life is just that. It's for a specific term, and it can be it can range really from 5 years to 30 years. And so you take that specific term, and when you do that, typically what you're doing is you're buying term life for protection only. So it protects you for a certain period of time in your life for a certain amount of money. Just like whole life, that could decrease too, you know. So you can have, it could be level term or it could be a variable term. In that, the premiums could start to rise after certain ages. As far as the whole life goes, we talked about all the variations of what you can do with the whole life as well. But the whole life really is something that you plan on keeping your whole life. I mean, till you perish. And what happens to the money at the end of a term policy? They do have a rider that has a return of premium. So there are mechanisms that you can get money back on a term policy as well. So in effect, you could use a term policy in some ways to have some savings there at the end of it.
You can also convert to term.
And you can also convert the term policy to a whole life policy. Typically, if you have a $250,000 policy, then you can convert that whole entire thing to $250,000 worth of whole life insurance. Now, if you bought the term life policy 10 years ago, your new rate for your whole life policy is going to be your current age, not the rate that you bought it of 10 years ago. And all it's usually guaranteed, so that's the age is going to be the biggest factor. On term life, for instance, let's just say that you just engaged in a 30-year mortgage and you have a $250,000 mortgage. You may want to buy $500,000 worth of insurance. Why? Because if you take the $250,000, you pay off the house, your wife doesn't have to worry about it. Or if it's the wife buying it for the husband, and then you've got $250,000 left to either compensate for the miss in income that you're bringing in, or to pay off some other bills, to get it to a level where your remaining spouse can afford things. And that's very important, because if you look at it in terms of that, and you're buying it for a specific debt like a house, you can say, okay, it's completely paid off, and now I don't have to worry about this, $2,000 a month for a mortgage payment, and that's like, $2,000 more worth of income that they don't have to go out and get. That's a big deal, because for some people it's a huge deal. It makes a difference between them staying in the house and not. And then if they have another $250,000 in this example, then they're either going to be able to pay off some bills, or they're going to be able to say, put $250,000 in the bank. I'm going to take the $3,000 a month that I'm missing now, and I'm going to use it until that time expires, which is 80 months or so down the road. So it's a good thinking process, and that's the way that we evaluate when we're selling people life insurance, is to say, what do you have? We need to know your assets, your liabilities, your income. We need to factor everything in, because when you leave, we want to make sure that you're not leaving everybody in a destitute situation. It's going to be bad enough that you're not there, but it's going to be even worse that if you just tumble everybody's life that you're leaving behind. It's a big deal. Let's talk about it.